I'm Mike Carr with Amber here as always, and this week I asked Amber to talk about interest rates and stocks. An awful lot of people are talking about interest rates and stocks, and I'm just not seeing what their message is. They're saying that high interest rates are a problem for stocks, and they stop talking. They're not really telling us the why. They're certainly not giving us an example, and they're leaving it like it's an act of faith. Well, we at True Options Masters really don't have faith in the market. We test everything. We understand everything based on the math. So what I did was I asked Amber if she could address that this week. I asked her if she would put something together, explain how interest rates affect stocks, and give us an example. So a real example instead of theory, real numbers, and I'm looking forward to seeing the results. So Amber, what do you have for us?
Okay, I'm going to need to share some slides here. So first I want to look at the usual answer, which is that analysts use DCF models to find price targets. These models require assumptions about sales growth, expenses, earnings, and a lot of other things, including interest rates. So that DCF is discounting the value of a dollar because of inflation. So a dollar today is worth more than a dollar 10 years from now. So the DCF model does math to quantify the difference. So basically, higher inflation drives higher interest rates and lowers the value of price targets. So the models are complex. Hang on here. But there are simpler approaches. So I do like the PEG ratio. This just compares the PE ratio to the earnings growth rate. There are still assumptions, but it's a simpler idea where one represents fair value and ratios under one indicate a stock is undervalued. This is obviously oversimplified a bit, and I do use some variants that make it slightly more complex, but it's simpler than a DCF model. So I like the PEG ratio because it accounts for the differences between stocks. A profitable tech company is probably more valuable than a utility. A standard PE ratio analysis where investors say stocks with PE ratios below 15 or some other number are undervalued misses that fact, while the PEG ratio accepts that fact. So this is a simple approach, but what I want to show is how this affects value. We can look at that on the next slide here. So here we have a company growing 10% a year and earning $1. I'm just making the math simple. So interest rates affect costs and sales. So higher rates increase borrowing costs for the company and can reduce sales by making it more challenging for the customer to buy things. So let's assume small changes, a 0.5% decline in earnings growth and a 1% drop in earnings. The fair value is the PE ratio times earnings per share. So that's the level where the PEG ratio equals 1. So the PE ratio in this model is equal to earnings growth. The small changes in the assumption reduce the stock's fair value by 6% here. So small changes in interest rates can have large impacts on stock prices.
Okay, so it looks like you did that. Now, basically it was the PEG ratio allows us to find a price target assuming that the PE ratio should be equal to the earnings per share growth rate. So if I know the earnings per share, I know the PE ratio, I know the growth rate, I can find a price target. Fairly straightforward. Turns out interest rates can have a significant impact. I like that. It was very small numbers. A multiple of that as far as the decline in earnings. So thank you for putting that together. I really appreciate it.
Yeah.
That's all we're going to have time for today. So we'll get back on this and other topics over the next few weeks. As always, comment, let us know what you want to see. Let us know what you don't want to see. If you like it, subscribe, click the like button, let us know what you're thinking. Thanks for joining us.